Okay, so when you think about Warren Buffett, sure, the billions come to mind. But what are the innovations behind that legendary success?
Right. It's more than just picking good stocks, isn't it?
Definitely. We're talking about a really unique and actually evolving approach to business and investing. Welcome to the deep dive.
Where we dig into the sources so you get the core insights.
And today, yeah, we're zeroing in on Warren Buffett's innovative path. We want to give you a clear sense of the key ideas that have fueled his incredible achievements over the decades.
And we've sort of broken it down into 7 main areas, looking at different stages or parts of his innovation.
Exactly. We'll kick off with how he mastered Benjamin Graham's value investing, then that big shift he made towards quality businesses.
And the structure of Berkshire Hathaway itself, that's a whole innovation right there.
Oh, absolutely. We'll get into his philosophy of patience, discipline, his focus on integrity and communication.
Can't forget his commitment to continuous learning. That's huge.
For sure. And finally, we'll touch on his legacy, philanthropy, all of that. So let's dive in.
You know, what's fascinating right from the start is, yeah, the financial results are just staggering, but the how,
Hmm.
the way he got there, it involved a lot of change, a willingness to think differently.
Absolutely. He wasn't static. Okay, section one, the genesis, mastering Graham's value investing.
Right at the beginning, Benjamin Graham, the father of value investing, huge influence.
Huge, but Buffett's innovation wasn't just, reading the book. It was the way he applied it, incredibly rigorous, disciplined, really digging into the numbers, the intrinsic value. He took it to another level.
That's a great point. Graham provided the map, the framework, but Buffett's early edge came from that laser focus on the data and sticking religiously to that margin of safety.
And you can really see this early innovation in maybe 3 key signs. First, that hunt for what Graham called cigar butt companies.
Yeah, not glamorous, but cheap.
Exactly. Maybe one good puff left in them, based purely on assets. Second, his absolute insistence on a big margin of safety, buying way below what he figured the company was actually worth.
A safety net, basically.
Totally. And third, his very detached analytical view, trying hard to ignore the market noise, the emotion.
Okay, so being that analytical, that disciplined,
Yeah.
what were the real upsides? What benefits did that give him?
Well, 3 big ones, I think. First, obviously the potential for really high returns when the market eventually caught on to the real value.
Right, when the price corrected.
Second, much lower risk. That margin of safety was a real cushion.
Makes sense.
And third, it gave him a clear system, a repeatable process for making decisions, taking the guesswork out.
So for, an entrepreneur listening now, how could they maybe use those early ideas?
Good question. I think 3 things stand out. First, using that same kind of rigorous financial analysis to really understand the value of their own business or maybe something they're looking to buy.
So your numbers, basically.
Yeah. Second, having disciplined, data-driven ways to decide on investments, whether that's buying equipment, funding, marketing, whatever, not just going on gut feel.
Okay.
And third, cultivating that patience, that ability to stay analytical, detached when making those big calls.
It's also interesting to think about what he wasn't doing then.
Yeah.
What were others doing differently?
Oh, yeah. Good point. Well, you had market timers, right? Trying to guess the next swing.
Always a risky game.
You had speculators chasing hype, the hot new thing without looking at the fundamentals.
Right.
And maybe even business leaders who just felt they had to constantly do something, make deals, stay busy. Buffett was content to wait.
So looking back at that early, intense Graham phase, what were the core lessons he probably walked away with?
I'd say 3 main things. 1, that hard analytical work really can find value others miss.
Digging deep pays off.
2, that buying value, not just chasing growth stories, is key for long-term success.
Value over hype.
And 3, that even the best analysis is useless without patience and discipline in actually doing it. Execution matters.
That's solid foundation, though. It really set him up for, a pretty major evolution in how he thought.
Totally. Which brings us right to section 2. The evolution quality over quantity. This is where Charlie Munger's influence becomes really, really apparent.
Munger. Yeah.
Buffett starts shifting, moving away from just cheap, maybe mediocre cigar butt companies towards what he called great companies, businesses with strong, durable advantages, economic moats.
Right. The idea that some businesses are just fundamentally better or stronger.
Exactly. And he became willing to pay a fair price, maybe even what looked like a higher price, for these truly excellent businesses. It wasn't just about cheapness anymore.
That's a huge shift. realizing that quality itself has immense value and it might be worth paying up for.
Definitely. And you see this shift play out in a few ways. First, he starts investing more in companies with like incredibly powerful brands, predictable models, like Coca-Cola, Geico, those kinds of names start appearing.
Businesses people understand and rely on.
Second, this deliberate focus on identifying and understanding those economic moats. What really protects this company from competitors? Is it the brand, network effects, low costs?
Really digging into the competitive landscape.
Yeah. And third, just that willingness to pay more. He wasn't demanding those massive discounts like in the early days if the business quality was exceptional.
Okay, so focusing on quality, what advantages did that bring compared to the old way?
Again, probably three key benefits. One, much more potential for sustainable long-term growth. These companies had built-in defenses.
Less vulnerable.
Two, they often needed less active meddling. Great businesses often have great management you can trust to just run things.
Right, decentralized approach.
And three, the sheer power of compounding. Owning these high-caliber assets over decades, that's where the really massive wealth creation happens.
So how can entrepreneurs listening apply this quality-first idea?
Well, three things come to mind. First, really focusing on building and defending a strong moat around their own business. What's your unique advantage? How do you protect it?
Crucial question.
Second, prioritizing the long-term health and resilience of the business model, maybe even over hitting some short-term financial target.
Thinking long game.
And third, understanding that truly great businesses aren't static. They adapt, they innovate to keep their edge.
Good point. Now, who might have been sticking to the old ways or different ways while Buffett was making this shift?
Well, you definitely still had strict quantitative guys, the deep value investors who just couldn't stomach paying what seemed like a higher price, even for quality.
Tuck in the old model.
Yeah. And then others chasing fads, getting into businesses with no real edge. Or maybe growth investors who were so focused on top-line growth, they missed underlying weaknesses or lack of a moat.
Right. So what were the big lessons learned during this quality evolution? I think three stand out. One, owning truly great businesses with strong moats is like paramount for lasting success.
Quality matters most.
Two, you need a deep, deep understanding of the actual business model, not just the surface numbers.
Yeah.
How does it really work? Why is it successful?
Beyond the spreadsheet.
Exactly.
Yeah.
And three, sometimes paying a fair price for a wonderful business is way, way better than getting a bargain on a mediocre one.
That evolution in thinking then enabled a really unique, well, a powerhouse structure.
Absolutely. Which leads perfectly into section 3, the structure building the Berkshire Hathaway platform. I mean, turning a failing textile mill into, well, into Berkshire Hathaway. That's an innovation in itself.
It's incredible. And a key part was how he used the insurance float.
Ah, yes, the float. Genius. Basically, the premiums collected up front that insurance companies hold before paying out claims.
Right. He saw that as a huge pool of low-cost long-term capital to invest and buy other businesses.
And combine that with a very decentralized management style, trusting the managers of the companies Berkshire bought to just keep running their shows.
Minimal oversight from headquarters.
Very minimal.
Yeah.
So the signs of this structural innovation. First, buying entire businesses across diverse industries, not just stocks, but whole companies like Jayco or BNSF Railroad.
Building a collection of operating businesses.
Second, that famously tiny corporate headquarters. It really signals the trust and autonomy given to the subsidiary CEOs.
Yeah, tells you a lot.
And third, obviously, the strategic, highly effective use of that insurance float as a permanent capital base.
So what were the main advantages of setting things up this way?
Okay, three big ones. One, super efficient capital allocation. Money could flow from the insurance side or from any subsidiary to wherever it could be best used across the whole group.
Like a central bank for the group?
Sort of, yeah. Two, it empowered those subsidiary managers. They felt ownership, responsibility, which usually leads to better performance.
Trust breeds results.
And three, it created this incredibly powerful financial engine. You had the reliable insurance earnings feeding capital, plus the earnings from all the different operating companies.
A flywheel effect.
Exactly. How might entrepreneurs, maybe, think about these structural ideas?
Well, three things. First, if you have different business lines, maybe a holding company structure could make sense for managing them, allocating capital, maybe even for future spin-offs.
Thinking about the architecture.
Second, really emphasizing trust and autonomy in your management team, empowering people.
Less micromanagement.
Right. And third, thinking creatively about your own capital. Do you have consistent cash flows like float that you can strategically deploy for growth or acquisitions?
Finding your own float. Interesting. Who was doing things differently, structure-wise?
Well, the opposite, really. Highly centralized corporations, right? Layers and layers of management, top-down decision.
Much traditional model.
Yeah, or private equity firms, they buy businesses, but usually with a shorter time frame and often a much more hands-on interventionist approach.
Different goals, different methods.
And even other insurance companies, many manage their float much more conservatively, not seeing it as this engine for buying totally unrelated businesses.
Okay, so key lessons from the Berkshire structure.
3 takeaways, I think. 1, the right structure can really unlock scale and diversification, but still allow for agility.
Structure enables strategy.
2, trusting good people to do their jobs is often way more effective than trying to control everything from the top.
People matter.
And 3, using capital creatively, thinking outside the box about funding sources, can be a massive driver of growth.
And this whole carefully built machine,
Yeah.
it was run with a very distinct philosophy.
Precisely, which is section 4, the philosophy championing patience and discipline. You know, in today's world, everything's instant, right? Quarterly results, constant news.
Yeah, the pressure is intense.
So Buffett's approach, he even called himself 99% sloth-like when it comes to activity. That's a real innovation. It's about making very few decisions, but making them carefully, with conviction.
And then holding on for a long, long time.
Letting compounding do the heavy lifting. That takes incredible patience and huge emotional discipline. Resisting fear, resisting greed.
Which is so hard for most people in the market.
Totally. And the signs of this philosophy are clear. First, holding investments for decades. Sometimes saying his favorite holding period is forever.
Not much trading going on.
Very little. Second, just staying calm during market meltdowns, focusing on the business value, not the stock price swings.
Easier said than done.
Oh, yeah. And third, that famous quote, be fearful when others are greedy and greedy when others are fearful. Classic Buffett, contrarian, disciplined.
So what are the payoffs for being so patient, so disciplined?
Well, 3 main benefits. 1, you maximize that power of compounding. Time is your friend.
Let the snowball grow.
2, you avoid a ton of transaction costs, brokerage fees, taxes, and you reduce the chance of making trading errors. Less activity, fewer mistakes.
Makes sense.
And 3, it's a huge defense against emotional mistakes. Panic selling, chasing rallies. Patience protects you from that.
And how can entrepreneurs apply this? I mean, businesses need to move faster than investments sometimes.
True, but the principles apply. 3 ways, maybe. First, developing a real long-term vision for the company and trying to stick to the plan, not just reacting to every little bump or trend.
Strategic patience.
Second, cultivating emotional intelligence in decision-making, especially when things get tough or uncertain. Don't panic.
Keeping a cool head.
And third, understanding compounding applies to more than money. Building knowledge, relationships, brand reputation, those things compound over time too.
That's a great point. Who's acting differently here?
Oh, lots of people. High-frequency traders, obviously. Their whole game is speed.
The complete opposite.
Active fund managers trying to constantly beat the market by trading in and out.
Lots of churn.
And just, impulsive leaders or individuals who react emotionally to news or market moves.
Okay, so the big lessons on patience and discipline.
3 crucial ones. 1, impatience is just. It's a killer for long-term success in investing and in business building.
Got to play the long game.
2, compounding is unbelievably powerful, but it needs time and consistency. You can't rush it.
The 8th wonder of the world, right?
Supposedly. And 3, mastering your own emotions is just as important as understanding the numbers or the market, maybe more so.
That internal discipline, it seems deeply connected to his ethics, too.
Absolutely. Which takes us to section 5, the human element prioritizing integrity and communication. Buffett puts a massive emphasis on integrity. Famously said, you look for intelligence, energy, and integrity, and if they don't have the last one, the first 2 will kill you.
Huh, yeah, he means it too. He's walked away from deals over it.
Exactly. So his innovation here isn't just being ethical, it's consistently demonstrating it and then communicating with incredible transparency and honesty, treating shareholders like true partners.
Even admitting mistakes publicly, which is rare.
So rare, especially in finance. And you see this in, again, maybe three things. First, just prioritizing integrity above almost everything else when hiring or partnering. It's non-negotiable.
Setting the standard.
Second, those annual letters, they're famous for being clear, candid, easy to understand, no jargon. He writes them as if talking to his sisters.
Treating people like intelligent equals.
Yeah. And third, as you said, openly discussing his own errors, what went wrong, what he learned. That builds incredible trust.
So what are the benefits of being so focused on integrity and open communication?
Three huge ones. One, it builds immense trust and a rock-solid reputation. With shareholders, managers, the public, that's invaluable.
Reputation is everything.
Two, it attracts the right kind of people. High-quality managers and business owners want to associate with that kind of integrity.
Like attracts like.
And three, his simple, clear communication style makes complex stuff understandable. It cuts through the noise.
So for entrepreneurs listening, how do they build this into their own businesses?
Okay, three applications. First, making integrity an absolute core value. Not just words on a wall, but in every decision, every action.
Walking the talk.
Second, prioritizing transparency. Being honest with employees, customers, investors, especially when things are tough.
Yields loyalty.
And third, consciously working to build a trustworthy reputation. Knowing it's a long-term asset you have to earn every day.
Who operates differently? What's the contrast?
Well, you see companies with really opaque reporting, right? Hard to figure out what's really going on.
Deliberately confusing sometimes.
You see leaders who seem to cut ethical corners for short-term gains.
That rarely ends well.
And just that flashy, maybe overly complex, hyperactive image you sometimes see in finance. Buffett's the opposite. Steady, clear, trustworthy.
So fundamental lessons here.
Three big ones. One, integrity isn't optional. It's the foundation for any lasting success.
Bedrock principle.
Two, transparency builds trust, and trust is the currency of business. And three, simple, clear communication is incredibly powerful for leadership, for building relationships, everything.
And this strong ethical core, it seems like it's constantly fed by this incredible curiosity he has.
Exactly right, which is section 6, the mindset, continuous learning, and adaptability. You can't talk about Buffett without talking about reading.
Yeah, the famous 5-6 hours a day or whatever it is.
He says 80% of his day sometimes. It's legendary. But it's not just reading annual reports. It's books, newspapers, industry journals, history, psychology, a huge range.
Always feeding his brain.
Always. And this constant learning allows him to keep expanding his circle of competence, to understand more businesses, more industries, and crucially, it helps him adapt. He's changed his approach over time.
He wasn't afraid to evolve, incorporating Munger's ideas, for example.
And again, admitting mistakes, learning from them is part of that adaptability. So the signs of this mindset. First, obviously that insane reading habit.
Can't miss that one.
Second, the clear evolution in his investment style we talked about earlier. He wasn't rigid.
Willingness to change based on new information.
And third, publicly owning his mistakes and analyzing what went wrong. That shows a real commitment to learning.
What are the benefits of being such a learning machine?
Three key advantages. One, it gives him incredibly deep knowledge for making informed decisions. He understands businesses at a fundamental level.
Knowledge is power.
Two, it helps him spot opportunities others miss, maybe because they don't understand an industry or a situation as deeply. Contrarian insights.
Think what others don't.
And three, it just makes him adaptable. The world changes, industries change. Continuous learning keeps him relevant.
How can entrepreneurs foster this in themselves and their teams?
Three ideas. First, just make learning a habit. Carve out time for reading, for studying your industry, for personal development.
Be intentional about it.
Second, actively try to expand your own circle of competence. Learn about adjacent fields, new technologies, things outside your comfort zone.
Broaden your horizons.
And third, create a culture where it's okay to fail, as long as you learn from it. Encourage analysis of mistakes, not just blame.
Learning from failure is key. Who misses out on this?
Well, leaders who get complacent, right? They have some success, they think they know it all, they stop learning.
Dangerous place to be.
Others who just rigidly stick to old models, even when the world is clearly changing around them.
Resisting change.
And maybe people who just avoid complex topics. They stick to what's easy, but the real insights are often in the complex stuff.
Okay, essential lessons on learning.
3, I think. 1, knowledge compounds just like money. The more you learn, the more connections you make, the smarter your decisions become.
It builds on itself.
2, adaptability is absolutely crucial for long-term survival. You have to be willing to learn and change.
Evolve or perish.
And 3, analyzing your mistakes honestly is one of the best ways to improve. Don't hide from them.
Turn errors into lessons. Finally, Buffett's innovation isn't just business. It extends to how he thinks about wealth, legacy, the future.
Exactly. Our last section, Section 7, the legacy integrating philanthropy and foresight. This is a really significant part of his story now, how he thinks about the wealth he's created and his impact.
Right. The Giving Pledge being a huge example, committing almost all of his fortune to philanthropy.
Primarily through the Gates Foundation, yeah. It's an extraordinary commitment, but it's also about integrating ethical thinking into his work and even offering foresight on big future issues.
Like his comments on AI, comparing it to unleashing a genie or the dangers of nuclear weapons.
Yeah, showing he's thinking about the big picture, the potential downsides of powerful technologies. Even his succession planning at Berkshire shows that long-term responsible thinking.
So, signs of this innovative approach to legacy. First, the sheer scale of his philanthropic pledge and donations.
Billions.
Unprecedented, really.
Second, his famously frugal lifestyle. It's not an act. It genuinely reflects his values about wealth.
Doesn't need the fancy stuff.
And third, yeah, publicly sharing those concerns about major societal risks like AI trying to spark a conversation. What are the benefits of thinking this way, integrating these broader concerns?
Well, 3 things. 1, obviously, massive positive impact on society through philanthropy, helping solve huge problems.
Using wealth for good?
2, it builds an incredibly strong ethical brand and legacy for him personally and for Berkshire.
A legacy beyond finance.
And 3, contributing valuable foresight, getting people to think critically about major challenges on the horizon.
How might entrepreneurs integrate some of this into their own thinking?
Okay, 3 potential applications. First, seriously considering the societal impact of their business and how their own wealth eventually could contribute positively.
Thinking beyond profit.
Second, practicing personal financial discipline. Living below your means builds security and options, regardless of your income level.
Frugality has its own rewards.
And third, thinking critically about the ethics of new tech in their field. What are the potential downsides of AI or automation or whatever is relevant? Being proactive.
Who takes a different approach here?
Well, the obvious contrast is people or companies totally focused on profit, with little or no thought to philanthropy or broader impact.
Just maximizing shareholder value, narrowly defined.
Leaders who dismiss the risks of new technologies, maybe chasing the upside without considering the potential harm.
Tech optimism without caution.
And businesses that just don't plan for the future. No clear succession, no long-term vision beyond the next quarter.
Okay, so wrapping up the lessons on legacy and foresight.
3 key thoughts. 1, wealth can be an amazing tool for positive change if you're intentional about it.
Wealth as a responsibility.
2, personal frugality isn't just about saving money. It enhances freedom and security.
Financial independence.
And 3, foresight and ethics matter. Thinking about the future, the potential consequences, is crucial for navigating responsibly.
So when you pull it all together, Buffett's innovation. It's not one single thing. It's this comprehensive, evolving philosophy.
Absolutely. It's the whole package. The deep analysis, the shift to quality, the clever structure, the incredible patience, the bedrock integrity, the constant learning, and that sense of legacy. It all works together.
Yeah, it's a holistic system. So for you listening, maybe think about which of these 7 pieces resonates most with you right now. Where are your biggest challenges?
Is it in your financial analysis? Building your competitive moat? How your team is structured? Do you need more patience? Is integrity front and center? Are you learning enough? Or are you thinking about your broader impact?
Because these principles, drawn from Buffett's journey, they really do offer timeless lessons for anyone trying to build something meaningful and lasting.
Definitely food for thought. Join us next time on the Deep Dive when we'll be digging into.
Okay, so when you think about Warren Buffett, sure, the billions come to mind. But what are the innovations behind that legendary success?
Right. It's more than just picking good stocks, isn't it?
Definitely. We're talking about a really unique and actually evolving approach to business and investing. Welcome to the Deep Dive.
Where we dig into the sources so you get the core insights.
And today, we're zeroing in on Warren Buffett's innovative path. We want to give you a clear sense of the key ideas that have fueled his his incredible achievements over the decades.
And we've sort of broken it down into 7 main areas looking at different stages or parts of his innovation.
Exactly. We'll kick off with how he mastered Benjamin Graham's value investing, then that big shift he made towards quality businesses.
And the structure of Berkshire Hathaway itself, that's a whole innovation right there.
Oh, absolutely. We'll get into his philosophy of patience, discipline, his focus on integrity and communication.
Can't forget his commitment to continuous learning. That's huge.
For sure. And finally, we'll touch on his legacy, philanthropy, all of that. So let's dive in.
You know, what's fascinating right from the start is, yeah, the financial results are just staggering, but the how, the way he got there, it involved a lot of change, a willingness to think differently.
Absolutely. He wasn't static. Okay, section 1, the genesis. Mastering Graham's value investing.
Right at the beginning, Benjamin Graham, the father of value investing, huge influence.
Huge. But Buffett's innovation wasn't just, reading the book. It was the way he applied it. Incredibly rigorous, disciplined, really digging into the numbers, the intrinsic value